Hello, everybody. In Chapter 17, we're going to be talking about accounting and financial information. In this chapter, we're going to be talking about the role of accounting information, the accounting cycle, understanding key financial statements, analyzing financial performance using ratios, and accounting disciplines. So, more than likely, everybody's heard of accounting. It's one of those things that if you're wanting to get into a business field, you're probably going to take multiple accounting courses. Either you'll have to take a managerial and a financial accounting course. Maybe you're going to major in accounting, and then if that's the case, then you're going to take numerous accounting courses. It can be a very good field to go into. It can be tedious work at times, but it can be very fulfilling. We'll kind of go over some of the different roles that you can play within accounting, and then just accounting in general here. So first off, the general question is, what is accounting? Accounting is the recording, classifying, summarizing, and interpreting of financial events and transactions to provide management and other interested in the information they need to make good decisions. Out parties such as employees, owners, creditors, unions, investors, and the government make use of firms' accounting information. So, just as it says here, it's going to be, financial information. I'm going to be talking about, if you have profits, losses, any sort of expenses. I mean, that's going to be all covered in accounting. It's going to be all done on spreadsheets, ledgers, and different things of that nature. If you're in accounting, you're going to be probably very well versed in Excel. So, like I said, it's a great field to go into, but at times, it can be a little bit tedious, just because there is a lot going on, especially with spreadsheets and ledgers. So as far as the accounting system goes, this is a really good figure. So, it starts with the inputs. So the accounting documents, these are going to be sales documents, purchasing documents, shipping documents, payroll records, bank records, travel records, entertainment records. And then it goes on to the processing of those documents. So entries are made into journals. So that's the recording portion of it. The effects of these journal entries are transferred or posted into ledgers. This is going to be the classifying of it. So if it does qualify as, an entertainment expense, a travel expense, payroll expense, anything along those lines, and then all accounts are summarized at the end. And then the final portion of it is going to be the outputs. So financial statements, and this is going to be your balance sheet, income statement, statement of cash flows, and any other reports such as like your annual report. So, whenever a company gets towards the end of the year and they're trying to figure out how well they did on their fiscal year, they're going to be look at their balance sheets and their income statements. And then this is going to be the information that's going to be disclosed to, the public if you're publicly traded company. So as far as accounting and their responsibilities, as you can see, most of it is due to tax and auditing. The accounting department or accountants. Most of you probably have some sort of interaction with accountants just from your taxes each year. So there are different organizations such as like H&R Block that'll go. You can go ahead and do your taxes through them. They do have online platforms, but especially for like those self-employed business owners, they're going to go and actually talk to a financial representative at H&R Block, just because they'll be able to discuss everything that they did in the previous year and kind of make sure that they get the full picture of it, and then that way they can get them the best return as possible on it. So some of the other things that accountants will do, cash management and forecasting, and then personal and financial planning also plays a role in that as well. So the accounting cycle, that's going to be a 6-step procedure that results in the preparation and analysis of a major financial statements. So the role of the bookkeeper, so bookkeeping is the recording of business transactions. Bookkeepers divide a firm's transactions into meaningful categories and post them into a record book or computer program called a journal. And then double entry bookkeeping, this is just the practice of writing every business transaction in 2 different places, done so they can check one list of the transactions against the other for accuracy. What you probably originally what a lot of companies did is they probably had a handwritten ledger, and then they also had an Excel document with the same information. Even though we do have technology today, a lot of times they will still do certain things like this, or they will just keep their data stored in 2 different places. That way, if one of these data sources goes down, they can still go back into the other one. And this is just to ensure that they never lose any of their financial documents throughout the years. So here are the steps involved in the accounting cycle. So, analyzing the source documents such as sales slips, travel records, recording the transactions, transferring, journal entries into the ledger, take a trial balance, and then prepare financial statements, and then analyzing those financial statements. Some of the bookkeeper tools, such as a ledger. This is going to be a specialized accounting book or computer program in which information from accounting journals is accumulated into specific categories and posted so that managers can find all the information about one account in the same place. So a general ledger, you can get those, like if you're going to be handwriting any of your accounting ledgers, you can get those at someplace like Walmart, Amazon. Pretty much anybody is going to have them. And then you can also use an Excel spreadsheet. There are different programs out there such as QuickBooks. Some of those more advanced programs such as like a QuickBooks will be able to dive into your information, kind of sort it for you, and kind of do a lot of the work for you, and then that way you're not spending as much time on. And then it'll also create additional reports beyond that for you to tell you here's where the bulk of your expenses are at. Here's some of the opportunities that you could have to save throughout the year. And yeah, it just kind of helps out the decision makers. And then you've got a trial balance, which is a summary of all the financial data in the account ledgers that ensures the figures are correct and balanced. Using technology in accounting, like I was talking about, you've got computerized accounting programs, post information instantly and from remote locations, so they work on the cloud program. And then accounting software such as Intuit's QuickBooks addresses specific needs of small businesses. So a lot of the times with QuickBooks, I know a lot of individuals that are self-employed to where they don't necessarily need an accountant. They'll just use QuickBooks, or they can do their own taxes because of QuickBooks, or it just makes their life a little bit easier whenever tax time does come around. They can use their QuickBooks, kind of upload that, or send that to their accountant. Their accountant can kind of comb through it, and then at the year they'll know exactly what they need to do for their tax documents. A financial statement is going to be the summary of all transactions that have occurred over a particular period. Key financial statements of businesses are, balance sheet, income statement, and then statement of cash flows. So just trying to figure out, where every dollar is going throughout the business. The fundamental accounting equation. So if you've ever taken an accounting course, or if you're going to take an accounting course, this equation is going to be kind of your bread and butter, and this is the first thing that you're ever going to memorize for an accounting course. And the equation must always be balanced, and this includes the formula of assets equal liabilities plus owner equity. For the balance sheet, this is a financial statement that reports a firm's financial condition at a specific time and is composed of three major accounts: assets, liabilities, and owner equity. And you're probably wondering what assets, liabilities, and owner's equity are, and we'll go over those in detail here shortly. So for assets, these are the economic resources, things of value owned by a firm. Items can be tangible or intangible. So, for assets for an organization, this could be property that they have. This could be, automobiles that they own. Any sort of money that's, in a financial institution that is also going to be an asset for them. And then liquidity, this is just the ease of which an asset can be converted into cash. So a lot of times, if you're looking at financial statements, or somebody's personal statements, you'll want to find out like what their liquidity is, and this is kind of wondering if they can sell everything right now, how much are they going to be worth. So if they have a lot of cash on hand, that's going to go into their liquidity, or if they have assets such as like automobiles, if they have property, different things like that, if they can sell that, how much is that going to be worth, and then that also factors into the liquidity as well. Services like dog groomers rely on the same set of financial statements as manufacturers like Ford and retailers like Macy's. What are some of the assets and liabilities a typical service business like this one would carry on its balance sheet? So for a dog groomer, they probably have some sort of building that they're working out of, whether they're leasing or owning. If they're leasing, that kind of falls under a liability a little bit because they don't have any ownership into it, but if they do own the building, that would count as an asset for it. Some of the additional assets that they have would be any sort of tools that they use, such as the scissors, any other supplies that they might have. Even if it is supplies that they're using on each dog and they're just kind of throwing away, those are still supplies going into your inventory, and that could also be counted towards their liquidity as well, because they can always sell those supplies at a later date. Some of the liabilities that they might have. A lot of dog groomers probably have a pretty high water bill. That's going to be a liability. Any sort of amount that they're owing somebody else is going to be counted as a liability for them. So classifying assets going to be categorized into 3 different categories. So you've got current assets. So these are the items that can or will be converted into cash within 1 year. You've got fixed assets, which assets that are relatively permanent, such as land, buildings, and equipment. And then you've got intangible assets, which are your long-term assets, such as patents, trademarks, copyrights, that have no physical form but do have value. So if it is a company like Google, they have tons of patents just for upcoming technology. Those are the intangible assets. Right now they're not producing any income, but in the long term, those are going to start to produce income for them, and then they can later on sell those patents for a profit. So liabilities. So this is going to be what the business owes to others, or debts. Common liability accounts are accounts payable, so current liabilities involving money owed to others for merchandise or services purchased on a credit but not yet paid for. So a lot of times bigger organizations will be working like on a credit account with somebody, and then they'll just pay them, either monthly, quarterly, yearly, something like that. Depends on kind of what agreement that they have. So a lot of times, bigger corporations will have like an accounts payable department, and that department is just designated to paying all the different liabilities that the corporation has. You've got notes payable, which are short-term or long-term liabilities that a business promises to pay by a certain date. And then you've got bonds payable, which are long-term liabilities that represent money lent to the firm that must be paid back. So bonds payable, if you want to look at it from like a public accounting standpoint. So if a town or a city is going to have a big project, such like a stadium build or something like that, they might have like bonds that they issue out for it. Consumers can buy those bonds, and then at a later time they will get paid back for it. Bonds payable fits into that category. Owner's equity. This is the amount of the business that belongs to the owners minus any liabilities owned by the business. To put it in kind of a consumer standpoint, whenever we talk about equity, that's kind of what we own. So like a good example would be your mortgage. So if your home is worth $100,000 and you have a balance of $50,000 on your mortgage left, you have $50,000 worth of equity into your home. It'd be the same thing for a business. So if a business if they have accounts payable of, say, $100,000, and then their assets are $100,000, then they would be at a 50% ratio for their owner's equity. You also have retained earnings, which is the accumulated earnings from a firm's profitable operations that are reinvested in the business and not paid out to stockholders in dividends. So at the end of the year, whenever a publicly traded company kind of reviews their financials and they give out dividends to their stockholders, they first have to figure out what our retained earnings are going to be. So they need to figure out what kind of projects they have coming up. If they're going to do remodels on their offices, if they're going to give any of their money in bonus back to their employees or anything along those lines, that's going to be figured into the retained earnings. Income statement. This is going to be the financial statement that shows a firm's profit after costs, expenses, and taxes. It summarizes all the resources that have come into the firm. This is the revenue, which we talked about earlier in the chapter, all the resources that have left the firm, such as expenses, and then the resulting net income or net loss of that. And the net income or net loss is the revenue left over after all costs and expenses, including taxes, are paid. So, if you did really well in the year, I think, early on in the chapter, we'll kind of go back to our original example of a lemonade stand. So if you, spend $5 on groceries for your lemonade stand and you have revenue of $10, then your net income in that is going to be $5. unless you have to pay taxes on that. If you did have to pay taxes of, $2 on that, then your net income at that point would be $3. So here's the statement, or the income statement, the formula for the net income. So it's going to be revenue minus cost of goods sold minus gross profit minus operating expenses equals the net income before taxes, and then you subtract the taxes out of that, and then that's where you get your net income or loss for that. So like I was talking about just a minute ago, if we go back to original example of a lemonade stand, you go out, you spend $5 in groceries for it, so that's the cost of goods sold, and then any minus gross profit on that, and then minus operating expenses. So if you're paying employees to work for your lemonade stand, you would take it out of that, and then that's going to be your net income before taxes. And then depending on how much money you make, it depends on how much taxes that you're going to have. So net income or loss. So whenever you do your personal financial taxes at the end of the year, that dollar figure that's going to be at the bottom of your taxes, that is also going to be your net income or loss, depending on what kind of year that you had. Hopefully, it's a net income for the year. Revenue, talked about that earlier in the semester, so just the monetary value a firm received for goods sold, services rendered, or other payments. Cost of goods sold, so cost of goods or manufactured, measure of cost of merchandise sold or cost of raw materials and supplies used for producing items for resale. And then gross profit or gross margin, how much a firm earned by buying or making and selling merchandise. Operating expense, costs involved in operating business such as rent, utilities, salaries. And then depreciation, which is a systematic write-off of the cost of a tangible asset over its estimated useful life. Really good example of depreciation is farmers usually have pretty high depreciation, or anybody who has a lot of equipment. You can have a write-off of that depreciation. Say it loses value at 10% a year, then that goes into factor into your depreciation. So Lonnie McWhirter owns a gas station that works with the local suppliers to provide customers with healthy organic food instead of the typical convenience store fare. In 2007, he took out a $875,000 loan to purchase the property and gas pumps from BP. His business now brings in $11 million annually in gross revenue. What is the difference between revenue and profit? We talked about this earlier on in the semester, but just to kind of go back to that original point. So revenue is going to be everything that the company is bringing in. And then, the profit is going to be the revenue minus any of the expenses for that, company. So in this example, it says his business now brings in $11 million annually in gross revenue. So they're bringing in $11 million, but that's not factoring into, how much he had in expenses. Say he had $9 million in expenses between salaries, between, purchasing all the items for his gas station, then his profit would be $2 million on the year. So generally accepted accounting principles sometimes permits accountants to use different method of accounting for inventory. So you have FIFO, which is first in, first out, and then you have LIFO, which is last in, first out. So each valuation can affect income in inventory valuation. Statement of cash flows. So these are the financial statements that reports cash receipts and disbursement related to a firm's three major activities. The three major activities of a firm are operations, investments, and financing. Operations, this is going to be covered under your salaries, or if you have any liabilities as far as expenses for your rent, any of your utilities, investments. So hopefully you're making investments towards either land that you own, or other investments such as stocks, bonds, different things like that. And then financing is if you're borrowing money from a financial institution, or kind of any dealings that you're having with any sort of financial institution. Most businesses incur operating expenses, including rent, salaries, utilities, supplies, and insurance. What are some of the likely operating expenses for companies like Starbucks? So for Starbucks, all of those expenses there at the top. So rent, salaries, utilities, supplies, insurance are all going to be covered under there. For supplies, you've got, the different types of coffee, you've got your cups, different things like that. Just pretty much everything kind of be broken down into this category. So whether they have a rent or a mortgage, salaries to employ pay your employees, utilities, water, heating, electrical, supplies like I just talked about, and then also insurance to make sure everything is covered within your company. So they might have some other expenses such as consulting. Maybe they're thinking about rolling out a new product or something like that. They can bring in a consultant, pay for that, but at the end of the day, that's still going to be kind of thrown in almost as a utility expense as well. The need for cash flow analysis. So cash flow, this is going to be the difference between cash coming in and cash going out of a business. So managing cash flow is a key consideration of a business. Obviously, you want a very good cash flow for an organization, and when it comes down to it, you want more cash coming in than going out. Careful cash flow management is a must for a business of any size, but it's particularly important for small businesses and for seasonal operations like ski resorts. Have you read any firms that were forced into bankruptcy because of cash flow problems? A lot of times what you'll see is, we'll use the ski resort for an example, where they're doing a lot of marketing, doing a lot of advertising. Maybe they're comping some people to come out to ski at the resort and that sort of thing. All those are going to be the expenses for the ski resort. So going to have a lot of money going out, but maybe they don't have a lot of money flowing in at that point. So if they're operating at a loss, they might be able to get away with that for a couple of years, but ultimately, I mean, they're going to have to answer for those losses, and then possibly file for bankruptcy at that point. So you do see companies that do operate at a loss, especially newer companies. They might operate at a loss for the first couple of years, but at some point you need to start focusing on turning a profit. And you will even see more established companies. State Farm, I think it was last year, operated at a pretty big loss. I forget the exact dollar amount. And like I was saying, you will have those situations just depending on, like for State Farm, for example. I mean, they had a lot of claims due to a lot of the strong storms in the south. Just overall not a great year for them financially. But they're a very big company. They're able to bounce back from that, and then the following year they operated at of its level, and they were bringing more money in than they were sending out. Ratio analysis. So this is the assessment of a firm's financial condition using calculations, interpretations of financial ratios developed from the firm's financial statements. So key ratios include liquidity ratios, leverage debt ratios, profitability, performance ratios, and then activity ratios. So liquidity ratios measures a firm's ability to turn assets into cash, pay its short-term debts. So key ratios include current ratio, asset test ratio, and then this information is found on a firm's balance sheet as well. Leverage debt ratios. These measure the degree to which a firm relies on borrowed funds in its operations. So key ratios include debt to owner's equity ratio. So important to compare the ratios of those firms or other firms. So for leverage debt ratios, if a company is not able to operate without a credit line at a financial institution, their leverage debt ratio would be very low. Financial institutions, bankers, they would look at that and kind of see that as a huge risk for that company. And then whenever it comes up to renew that credit line, they'll take a look at it and say, you're not operating at a reasonable level. They might opt to not even renew the line at that point. Profitability performance ratios. These measure how effectively a firm's manager is using the firm's various resources to achieve profits. So some of the key ratios include earnings per share, return on sales, return on equity. So profitability ratios are very closely watched as measures of growth and management performance. And then I think it's next chapter we'll actually go into these in a little more detail and how it relates to publicly traded companies and how you can actually find those on different finance websites such as Google and Yahoo. Activity ratios. So this is going to measure how effectively management is turning over inventory. So key ratios include inventory turnover ratio and then rates of inventory turnover vary from industry to industry. A good example of that would be, an auto manufacturer, just kind of looking at the ratio of, how much inventory is coming in, how long they're sitting on that inventory. If it's sitting in a warehouse for a very long amount of time, that's going to factor into their ratio, and then how fast they can turn that inventory into a product, and then turn that product into a profit. Restaurant owners accept servers to turn over tables quickly so they can seat as many customers as possible. After all, more dinners means more money for the owner. Can you think of any other industries that depend on high rates of inventory turnover? The example I just used of like an automobile manufacturer, that's another really good one. Even to think like in kind of like a consumer-based products such as like one of the movie theaters. Whenever you get done with a movie, they usually try to get you out of the movie as quickly as possible, and then get in there and clean that up. Then that way, the next movie can start on time. That way, they're not delayed by anything. Even though by the time you get in to the movie, you still have to wait for a half an hour for the movie to start, anyways, because of all the previews and everything. But that would just be another example. So there are different disciplines in accounting. So like I was talking about, early on in the slides, if you're going to continue on through business courses, or if you're going to become an accountant, especially if you're going to become an accountant, you're probably going to take courses in all of these disciplines. But if you're just going to go on and just do kind of a bit of general business administration degree, financial accounting and managerial accounting are two classes that you'll have to take. So to just kind of familiarize yourself with that right now. So accounting information and analysis prepared for people outside the organization is financial accounting. So outside users are interested in these questions. Is the organization profitable? Is it able to pay its bills? And then how much debt does it owe? If you're a financial institution looking to lend money to an organization, these are all questions that you're going to ask. So that would be a really good example of financial accounting. Annual report. So this is going to be a yearly statement of the financial condition, progress, and expectations of an organization. Any publicly traded company is going to release an annual report every year. Even a company like SEFCU, we send out an annual report every year, and you can walk into any one of our member centers, and we'll have an annual report from the previous year, listed right there, at our receptionist desk, and then that way our members can always look at it and see, how were our profits, how were our loss, or if we did have any losses last year, which knock on wood we haven't, but just kind of how we're doing overall as an organization. So working with internal departments, so assembling a truck engine requires many tools, parts, raw materials, and other components, as well as labor costs. So keeping these costs at a minimum and setting realistic production schedules is critical to a business's survival. What other internal departments must management accountants team with to ensure company competitiveness? So, a really good example would just be like HR. We want to make sure that we're getting the best employees possible in this situation. So, whenever we're talking about labor costs, if we have a bad employee who is not, doing very well at the job, maybe they're taking a little longer period than usual compared to the next employee, or maybe they're just kind of having issues just getting to work on time or just coming to work at all. Those are all going to factor into their labor costs. So that would be a really good thing to where accounting can kind of work with HR to ensure that they're getting the best employees possible. Just because time is money in these situations, so you want to make sure everybody's kind of clicking on the on all cylinders and everybody's on the same page. So some key things to watch out for and also read. So management's discussion and analysis of operations, and then your balance sheet, income statement, statement of cash flows, and then auditor's opinions. So like I said, all this information is going to be available to the public for like a generally publicly traded company. So then, like I said, we'll go over this also in the next chapter whenever we kind of go over key financial ratios and just kind of stocks and bonds. Continue on with different types of disciplines. So we have a private accountant. So this is an accountant who works for a single firm, a government agency, or nonprofit organization. You have a public accountant, an accountant who provides accounting services to individuals or businesses on a fee basis. This is probably going to be somebody that you're going to be working with for the most part. Somebody who you're going to do your taxes or something like that. And then you have a certified public accountant, which is a CPA. An accountant who passes a series of examinations established by the American Institute of Certified Public Accountants. If you're going to become an accountant, I highly recommend becoming a CPA. And most organizations will require you to become a CPA if you're going to be working in the accounting department. It pretty much just kind of solidifies that you're a very good accountant, and you're not going to do kind of anything sketchy, and pretty much all the bylaws accounting has put out there. And, as far as a CPA goes, the exam itself can be very difficult. I've heard different people say that the CPA exam is just as hard or harder than the bar exam that lawyers take. So, it can be a very daunting thing. I've never taken the CPA exam, but I do know a couple of individuals, especially ones that I went to grad school with, who went on later to get their CPA. So it can be a very challenging thing, but in the end, it's worth it just because you can make a pretty good profit, as a CPA. So, the Dodd-Frank Wall Street Reform and Consumer Protection Act, both of these are in the news quite a bit right now. So these are increased financial regulation by increasing the power of public company accounting oversight boards. So the Dodd-Frank that was put into play, after the recession in 2008, it's one of those things that the government's talking right now. Do we need to roll it back? Does it not need to be kind of as stern as it is now? So that's one thing to kind of watch out for in the news, to see kind of what they're going to do with that. And then like I said, this was the act that was brought on by the recent financial crisis. Sarbanes-Oxley Act, prohibits the accounting firms from providing certain non-auditing work to companies that they audit, strengthens the protection of whistleblowers who report wrongful actions of company officers. This requires a company's CEOs and CFOs to certify the accuracy of financial reports, and imparts strict penalties for any violation of securities reporting. And this prohibits corporate loans to directors and executives of the company. So the Sarbanes-Oxley Act, I keep messing that one up, was pretty much a direct result due to Enron. So for those of you that don't know what Enron was a company that was based out of Houston, Texas, that essentially traded energies. So whether it be gas, wind energy, solar energy, different things like that. They kind of acted almost as a New York Stock Exchange for those energies, and then they would trade them, sell them through Enron. There's a lot of documentaries out there on Enron. They're all pretty interesting. Just kind of see how Enron was working. They were essentially just cooking the books over many years and saying that they were making record profits when in reality they weren't making any profits at all. It was just kind of all made up. And due to that, that's why we have the Sarbanes-Oxley Act, which pretty much just kind of says that there needed to be more auditing for situations like that. And then it also put ownership onto the CEOs and CFOs, because that's what happened with Enron is, their chief officers, they pretty much got away scot-free on a lot of that stuff just because there was no ownership on it. So they were kind of like directing things, but they weren't signing off on certain things just because they knew that they would get in trouble if they did that. So, it was very shady practice. And if you do watch any sort of documentary on it, Enron was, partially responsible for Arnold Schwarzenegger getting elected governor of California, which is a really weird thing to think about, and it was a really weird time in the United States, and especially for the state of California. So yeah, I would highly recommend going out and doing some research about kind of Enron, everything they did, and then the long-lasting impacts that Enron had, on the state of California, on the state of Texas, the city of Houston as well. And then just kind of the United States, in general, just because it did, result in the Sarbanes-Oxley Act. So continue with that. So the Sarbanes-Oxley Act establishes the 5-member public company accounting oversight board under the Securities and Exchange Commission to oversee the accounting industry. And then it stipulates that altering or destroying key audit documents will result in felony charges and significant criminal penalties. Kind of the same thing where a lot of these companies, especially during the financial crisis, they were kind of getting rid of all the documents just to kind of save, their own rear ends, and then thanks to the Sarbanes-Oxley Act, that became a huge no on that. Managerial accounting. This is going to be the accounting used to provide information and analysis to managers within the organization to assist them in decision making. So managerial accounting is involved with the cost of production, cost of marketing, preparation and control of budgets, and then minimizing tax liabilities. So if you're a manager, if you're working in the accounting department, if you're CFO, managerial accounting is going to be something that you're going to deal with on a daily basis. Auditing. This is the job of reviewing and evaluating the information used to prepare a company's financial statements. Whenever we think of like auditors, whether it be through government or if you're working for an organization, you have auditors like a third-party auditor coming in. Typically not something that you want to have, but I mean they are there to kind of look through everybody's books, make sure everybody's functioning correctly. So it's not going to be the most fun that you're ever going to go through, but it is a good thing to have auditors come in and review your files. Independent audit is an evaluation on an unbiased opinion about the accuracy of a company's financial statements. So this is going to be like having that third party come in and go through your books. So most organizations will have an internal audit department, and then they will also have an independent audit firm on retainer, and then that way they can have them come in and look at your files as well. So it's always a good idea, especially in a financial institution, to have as many kind of eyes and ears on all of your records to make sure that you're up to par on everything. Tax accounting. So tax accountants are an accountant trained in tax law and responsible for preparing tax returns, developing tax strategies. Think H&R Block on that one. And then government and not-for-profit accounting. So these are accounting systems for organizations whose purpose is not generating a profit but serving rate payers, taxpayers, and others according to a duly approved budget. So that's all I've got for Chapter 17. We'll see you next time in Chapter 18.